What if I told you the secret to making legendary profits in the markets was in a complex algorithm, secret indicator, or even inside information? What if the most powerful trading strategy was simply doing nothing? It sounds almost absurd, right? In a world that glorifies constant action, where traders are glued to their screens, executing dozens of trades a day, the idea of sitting on your hands seems like a recipe for failure. Yet this counterintuitive approach is the very cornerstone of the philosophy that made Jim Rogers, the co-founder of the legendary Quantum Fund alongside George Soros, one of the most successful investors in modern history. His guiding principle wasn't about being the busiest trader in the room, but the most patient. He built his fortune on one deceptively simple, yet brutally effective idea. I only invest when I'm sure, otherwise I do nothing. This isn't just an investment tip. It's a profound shift in mindset that challenges everything we think we know about making money. For most people, the pressure to do something is immense. The flashing lights of the market, the constant stream of news, the fear of missing out on the next big move, it all creates a powerful urge to act. We feel like if we're not constantly buying or selling, we're falling behind. Rogers saw this impulse not as a strength, but as the single greatest weakness an investor can have. He understood that true power doesn't come from frantic activity, but from a deep, unshakable discipline to wait. He believed that patience wasn't just a virtue, it was the ultimate edge. It's the ability to sit calmly sometimes for years, while others chase fleeting trends waiting for that one perfect opportunity. An opportunity so clear, so overwhelmingly obvious that the decision to invest feels less like a risk and more like picking up money that is just lying on the sidewalk. This isn't laziness. It's the disciplined inactivity of a predator waiting for the perfect moment to strike. But how did Rogers develop such extraordinary conviction? It wasn't by staring at charts or reading the same Wall Street reports as everyone else. His secret was to get his boots on the ground. Rogers famously embarked on global road trips, covering hundreds of thousands of miles by motorcycle and car, long before emerging markets was a buzzword. He didn't just visit capitals. He explored the forgotten backroads of countries like China, Peru, and Botswana. Instead of scheduling meetings with financial analysts in sterile boardrooms, he would talk to the real people driving the economy. The farmers tilling their fields, the taxi drivers navigating city streets, the small business owners struggling and innovating on the front lines. This gave him a rare, ground-level perspective, a feel for an economy that no spreadsheet could ever capture. He was spotting monumental economic shifts years, sometimes even a decade, before they appeared on Wall Street's radar. This combination of boots-on-the-ground research and extreme patience was the formula that powered the Quantum Fund to historic returns. Rogers and Soros didn't dabble. They didn't make 100 small bets hoping a few would pay off. They operated with the precision of snipers, waiting for a target so big and clear that they couldn't miss. Their most legendary trade, the one that broke the Bank of England, was a perfect example of this. In 1992, they saw that the British pound was artificially overvalued and that the UK government could unsustain its position. The economic fundamentals were screaming that the pound had to fall. It wasn't a hunch. It was an economic inevitability. So they didn't just take a small position, they bet the farm, shorting the pound with immense conviction. The result? Profit of over $1 billion? It was a move born not of reckless gambling, but of a long, patient wait until the odds were overwhelmingly, undeniably in their favor. This pattern repeated itself throughout Rogers' career. In the late 1990s, while the entire world was caught in the euphoric frenzy of the dot-com bubble, Rogers was looking elsewhere. Everyone was chasing tech stocks with no profits and astronomical valuations, convinced that this time is different. But Rogers, grounded in his understanding of real-world economics, saw it for what it was, a mania disconnected from reality. Instead of joining the party, he quietly began investing in something everyone else was ignoring: commodities. To the tech-obsessed crowd, it seemed like a foolish, old-fashioned move. But Rogers saw that years of underinvestment had created a massive supply shortage in raw materials. He knew that eventually the world would need oil, copper, and sugar far more than it needed another profitless website. And when the dot-com bubble inevitably burst in 2000, wiping out trillions in paper wealth, the commodities supercycle he had positioned for began its historic run, proving him spectacularly right once again. His foresight on China is perhaps the most stunning example of his approach. Long before Western headlines were celebrating China's economic miracle, Rogers was there, traveling the country and witnessing the transformation firsthand. In the 1980s, when many in the West still viewed China as a poor, backward nation, Rogers saw the ambition, the energy, and the sheer scale of the change happening on the ground. He saw the first seeds of a market economy being planted, the unstoppable work ethic of its people, and the government's determined push towards modernization. He famously declared, "The 19th century was the century of the UK, the 20th century was the century of the US, and the 21st century will be the century of China." He didn't come to this conclusion by reading a government report. He came to it by observing the furious pace of construction, the burgeoning factories, and the palpable sense of optimism in the air. He was buying into China's future when it was still a contrarian, almost radical idea. From these experiences, Jim Rogers distilled a set of powerful lessons that cut through the noise of modern finance. First, he implores us to think big picture. Stop getting lost in the chaotic squiggles of 5-minute charts. The real money isn't made by predicting the next few ticks of the market. It's made by understanding the massive multi-year global trends that are reshaping our world. Are we moving towards electric vehicles? Is there a looming water crisis? Countries are investing in their infrastructure for the long term? These are the questions that lead to life-changing investments. Second, and most importantly, master the art of waiting. Rogers emphasizes that not acting is often the hardest and smartest thing a trader can do. The market is a master at seducing you into making foolish moves out of boredom or fear. Resisting that seduction, having the discipline to sit on your cash for months or even years until a true opportunity presents itself, is a skill that must be cultivated. It requires immense self-control and a deep-seated confidence in your own judgment. Finally, when that opportunity arrives, bet big. This isn't about being reckless. It's about having the courage of your convictions. After you've done the deep research, after you've waited patiently, and when the odds are so clearly stacked in your favor that it feels obvious, that is the time to take a calculated, significant risk. As Rogers would say, when you see money just lying there in the corner, you don't go over and pick up a little bit of it. You go over and pick up all of it. This is how fortunes are made, not through 1,000 tiny wins, but through a few massive, well-timed victories. In Rogers' worldview, not doing anything is the ultimate form of discipline and control. It's an active, strategic choice. The average trader thinks their job is to trade. The legendary trader knows their job is to wait. It's a profound realization that the most profitable action you can often take is no action at all. It's about preserving your capital and, just as importantly, your mental energy for the moments that truly matter. Sitting on your hands isn't a sign of indecision. It's the hallmark of a professional who refuses to play unless the game is rigged in their favor. A young, aspiring trader once asked Jim Rogers for the secret to getting rich fast. Rogers' reply was simple, yet contained a lifetime of wisdom. Sit and wait. Wait until the market gives you an opportunity so clear, so compelling, that you simply cannot ignore it. He wasn't offering a shortcut, but a hard truth. He was teaching that the path to wealth is paved, not with frantic clicking, but with profound patience. Ultimately, his philosophy is a brutal but liberating diagnosis of why most people fail in the markets. We don't lose because we lack knowledge, charts, or information. In today's world, we're drowning in all of that. We lose because we lack the emotional fortitude to wait. We lose because we are impatient. And in the high-stakes game of investing, patience isn't a passive, gentle quality. It's an aggressive, powerful, and strategic weapon. It's the one secret that separates the legends from the crowd, the signal from the noise, and a lifetime of mediocre results from a legacy of massive profits.